Hi, this is Alan Gassman. I'm here with Paul Hood, and we're going to talk about running the numbers on charitable lead annuity trusts. The charitable lead annuity trust is a very dynamic and very effective way to get an income tax deduction while you're alive, to avoid federal gift and estate tax, and to zero out estate tax on death. So I'm so pleased that Paul is joining me here. We're going to talk about not only charitable lead annuities, but also using estate view software to run the numbers on charitable lead annuities. If you're watching this program, if you're a paid Lineberg watcher, then you get our estate view software for free for 30 days. Just let us know, or if you already have estate view software, let us know, and we will send you a special prize. But if you'd like to play with the software on a second screen while we're actually running some numbers, you can do that. Just put the word estateview.link in your browser. That's at the top left-hand side of your Google Chrome. And then just click log in. And if you click log in, you will be on there and you can play along with us if you like. So EstateView has a number of calculators, and several of them are charitable calculators. Today, we're just going to talk about the married couple calculator for a little bit and the charitable lead annuity trust calculator. If you're new to this field or you want to kind of get your feet in the ground, a charitable lead trust basically has two components. The first component is the charitable lead. And by the terms of the law, the charitable lead trust locks in an obligation to pay a charity or charities an annual amount for a set term of years. And Paul's going to describe a little bit about how that works in a couple of minutes. After the charity or charities receive their stream of payments, what's left can be held for children and other non-charitable beneficiaries without incurring estate or gift tax. There can be generation skipping tax implications, but this is a great way to benefit charity and then have assets passed to your children almost like a quarterback sneak. There are two kinds of charitable lead annuity trusts. The first one is what we call the grantor CLAT. And just like a defective grantor trust, the charitable lead annuity trust is formed during the lifetime of the grantor and is considered to be owned by the grantor for the term of the trust. The grantor gets an income tax deduction pretty much as if the assets put in had gone to charity, but also pays income tax along the way on the income earned by the charitable lead annuity trust. If the grantor dies during the charitable lead payment term, then the income tax savings is basically reversed or recaptured. So some families will buy life insurance on the grantor's life to take that risk into effect. With a non-grantor CLAT, there is no income tax deduction upon funding, but the grantor does not pay the income tax. The CLAT is subject to income tax on its income, but because it gets a deduction for what goes to charity, a non-grantor CLAT will generally not pay income tax and may be a good reciprocal for assets that would cause a lot of income tax. The purpose of the non-grantor CLAT is normally to avoid federal, estate, and gift tax. So the anatomy here of an effective system would typically be that you have your charitable lead annuity trust there in the middle. It may agree by the terms of the trust agreement to pay a certain amount to charities during a term. The grantor can retain the right to replace or change the charities during the term as long as they are the right category of charities, which we can discuss. And what's left at the end then goes to the children. So this is a illustration that we prepared back when the 75/20 rates were much lower than they were now. The client put $1,209,000 of investments into an LLC, gifted the 99% non-voting member interest to the CLAT. The CLAT paid $100,000 a year for 10 years to charities. And at the end, the children received $848,000 based upon the rate of return. It was a very, very efficient and effective estate and gift tax maneuver. So, Paul, I'm going to ask you now, you've been listening so attentively and so patiently. What are you just dying to say at this point?
Well, I will tell you that I have great respect and made great use regularly of the charitable lead annuity trust. Um, but with only one exception for lifetime CLATs, I never did one that didn't involve a plaintiff lawyer winning a big case that year. But most of mine were testamentary, formula driven TCLAT, testamentary charitable lead annuity trusts, with a formula that, using a combination of the term and the AFR, which obviously we won't know until the client's demise, will zero out the estate tax liabilities. It was a garden variety tool when I was in practice.
Okay. And anything you'd like to clarify from what I've said so far?
No, I think you stated as well as I could have said it myself, if not better.
Okay. One of the most common uses for the CLAT that our law firm has is a disclaimer provision. So we'll provide in the document, the residue of my estate will go into 3 trusts for each of my children. To the extent that the trustee of one of those trusts disclaims the assets, they will go to a zeroed out 20-year CLAT to pay payments for 20 years to charity, and then what's left after the 20 years will go back into the trust for my child. Then the child, after the death of the client, can talk to the trustee and discuss whether the child would recommend that the trustee make a disclaimer in whole or in part to avoid the federal estate tax. So what I'd like to do now, I'm going to show you. Are you able to see my screen, Paul, and see the software at this point?
Yes, I'm seeing the screen change as we speak.
Okay, well, one way to help clients get accustomed to the CLAT is to go to the married client section, click on married clients, and then the married client section sets up a illustration of, in this case, Bob and Mary Sample, and allows you to use different strategies to get their estate tax reduced. For example, with no planning, they're looking at a $22 million estate tax. With a credit shelter trust, they're looking at a $20 million estate tax. With annual gifting, they're looking at a $16 million estate tax. Well, if I use a lot of strategies and the estate tax is now 15 million, I can come down here to the bottom left and I can put in a CLAT, and I can provide that 100% of what would be taxable would go to the CLAT instead of going to the descendants. And then I can provide that 50% of the CLAT will end up going to the children after 22 years. So here you see, before planning for the CLAT, $15 million of estate tax, 65 million going to the children. When I click on testamentary CLAT, now there's 0 estate tax. The CLAT, though, has to receive $38 million. The children initially receive 43 million instead of 65 million, but in 22 years, we're showing them getting another 19 million. So they end up with 61 million, certainly less than what they were going to get. But the estate tax is 0. Now, this is an illustrative item. The numbers are not actually run here. It's just a matter of telling the client what you want to see. But another example would be maybe the CLAT would receive 50% of what it would take to wipe out their estate tax. Now the children are at 55 million almost, estate tax 7 million. And then you see the charities get almost 10 million. And many clients would prefer to see the charities get the 10 million to save the estate tax. So this is simply illustrative. Paul, any questions, comments, or suggestions on that?
I think that it's good to point out that you don't always come out better by doing good or charitably. In fact, I'm dubious every time someone makes that claim that you can do better by being charitable. And I said, well, I've never seen it, and I've seen everybody try it every which way. But on the lead, I found that it worked as well for clients who weren't easily insurable. I had a lot of clients down there that had, they were land and oil and gas and timberland wealthy, but not cash rich. And a lot of them weren't in great health. And they can't buy life insurance or can't buy it at a reasonable cost. But a lead trust with a formula allows us to basically ratchet down the amount of their estate tax paying, and we can take it to zero. I mean, sometimes we create some difficult situations to make that charitable payout because the percentage is high, but it's a very, very effective tool when properly designed.
Now, if the client doesn't want the complexity, then you could just click it directly to charity. But then there's less for the descendants. But so that's the married couple function in estate view. Now I will take you to the CLAT calculator. I go to calculators there, CLAT, or another way to get there is I can click on home and then I can go to CLAT. And in estate view, we always start off with what we call the standard mode, which is generally what the other software programs do. Maybe some of them do a little bit more, just to keep it simple. So a typical CLAT or any CLAT, we're going to have a transfer date. We're assuming a date in March. And then estate view tells you that you use a 75/20 rate and that you can select the best of the three. This month's, last month's, that's February, and January, and you want the lowest. That's going to give you the best result. So estate view automatically loads in a 4.8% 75/20 rate. Now it's not as good as it was when it was a 1% 75/20 rate or a 0.4% 75/20 rate. But Paul, why do they call this the hurdle rate, and what does that mean?
Well, it all goes back to when the IRS started issuing the rate of the month back in May of 1989. I gave one of the very first talks on this subject, which is how Steve Weinberg and I originally became friends, because he wrote an article about it very early on too. But one question I have for you at the outset: this lead trust that we're about to model, is this a lifetime lead trust or is it a testamentary lead trust?
It could be either.
Okay, well, I mean, I think it's important because if it's a lifetime, then you're going to have the question: is it going to be a grantor or a non-grantor?
Right. But we start off in a simple mode here where it's just a 10-year CLAT, grantor or non-grantor, level payments, assets growing at 7.5%, and $1 million placed in it. So then to click the results, we click on see results. When we click on see results, we have the same inputs on the left-hand side. They're just smaller now. And then we have those inputs summarized in blue, a 10-year CLAT, $1 million start value, asset growth rate 7.5%, payments level 75/20 rate 4.8%. And this tells us that our annual payments for the 10 years are going to be $128,250 a year. And the value of the remainder interest is $2. And what's expected to be in the GRAT at the end of the term with a 7.5% rate of return is $246,000 that passes free of estate tax. Now, this is a very non-aggressive CLAT.
This is a loser class.
This is a
Call it what it is.
Well, but the Biden-Green book says that these CLATs will be equal payment terms with a 10% remainder. So
nobody will do them.
Right. Now, just to show you how the software works a little bit more, this is a very simplified CLAT, but Jerry Hesh said you have to have a simple version or everybody will get lost. So I'm going to click on duplicate there. You see the green button duplicate. When I click on the green button duplicate, now I have CLAT number 2 across the bottom, and it's identical, but let's show you something we could do with CLAT number 2. CLAT number 2, we could go to 15 years. And let's see how 15 years looks. So I got CLAT number 1 at 10 years, CLAT number 2, 15.
Not what I expected.
And now there's almost twice as much in that CLAT at the end of 10 years, at the end of 15 years than 20. And then I can prove my point again with CLAT number 3. And I can go to 20 years, which is what we normally see. And now that savings is a lot better, but is it that much better? Because they have to wait twice as long to get there.
You know, most of mine, Alan, were 25 to 30 years on balance.
Yeah. Well, let's duplicate that and go and see what 25 years is. 25 years, $1.3 million. Pretty nice. And let's even go 30 years. 30 years, $2.1 million. So those are some pretty good results, but I think I'll duplicate CLAT number 3 here and look at this 20-year CLAT again. So there's a 20-year CLAT, there's a 20-year CLAT, but instead of level payments, let's just emulate what a GRAT does, which is very safe, and have the payments start smaller and increase by 20% a year. So I'll just click increasing 20% a year. So now this CLAT number 6, which we can compare to CLAT number 3, the first payment's only $78,000. And what's left should be quite a bit more. Let me see what
Yeah, 460,000, 50,000.
Yeah. Right.
That's what I expected.
So, I see. Yeah, by increasing 20% a year, we have $1,289,000 versus 831,000. So that was very worthwhile to increase by 20% a year. You would never want to do an equal payment CLAT. But then the next one that I want to do, I'll duplicate number 6. And now I want to see a shark fin CLAT. Now, a shark fin CLAT, as you know, starts very small and then goes way up at the end. And I'll click on shark fin CLAT. You got the shark fin going across the screen there. And now you have $1.5 million. So I put $1 million in, I get $1 million income tax deduction. I get $1.5 million passing to my descendants 20 years from now, estate tax free. So that's why the shark fin CLAT is popular. But Paul, isn't the shark fin CLAT a little bit daring?
Well, it's not only daring, but remember that CLAT, if this is a lifetime CLAT, is taxable. Okay, so even if it's not a grantor, it's a non-grantor, that you're paying a lot of money for that benefit, because the CLAT itself is subject to subpart E of subchapter J, a fiduciary income tax. at the lowest, highest marginal rate breakout. Was it about 15,000 this year or something like that, as opposed to husband and wife? I mean, it's probably somewhere in the 640 and 50,000 range, isn't it?
But if I put the CLAT, if I fund the CLAT with growth stocks.
Oh yeah, well no, it can be managed around. I'm not saying it can't be managed around, but that's the thing, is that sometimes people get into these things and like, but then their asset, 60/40 bond equities fund, and they're getting dividends, and all of a sudden the trust is starting to generate some big income tax. You're like, oh, you didn't tell us about this. And, well, no, we kind of did, but maybe we didn't say it as well as we should have.
Right, right. Okay, so now when I click on the pro version, there's three versions of Estate View. Standard's $199 a year, Pro is $399 a year, Pro Plus $499 a year. So anyway, when I click on Pro, then Jerry Hesh gets lost a little bit. But when I click on Pro, now I'm going to get a lot more information on these CLATs. So what's in blue across the top is what I had before, and what's in green across the top and the illustrated version is what I had before. But now it is showing me the client's life expectancy, and I just happened to put in that the client was 70. If I change it, then the life expectancy will be shorter, but this is telling me for a 70-year-old, it's a little bit daring to do a 15-year CLAT, although the life expectancy is off the 2010 IRS tables and is a bit pessimistic. And then it shows me I'm doing Grantor CLATs, shows me the value before discounts, shows me I'm not taking a discount yet, shows me the value after discounts, shows me a growth rate, shows me that payment term. There's your shark fin, there's your increasing 20% a year. Shows me my first year annuity amount, shows me the total going to charity, shows me that income tax savings, and then what I like in particular is it gives you an idea of the present value of the remainder. I mean, it sounds great. My kids are going to get 3.2 million in 30 years, but the present value of that, based on a 4.8% discount rate, about 800,000. So it's good to know. It's more intellectually honest. In fact, here, present value, I'm getting an income tax saving of 362. 56% really is going to charity in CLAT number 7. 44% is really going to my children. So, it may not be as advantageous as people would have thought.
I wanted to point out one thing, and this probably would surprise many of the people, and that is the two highest charitable payouts by total are the increasing 20%, even though you started with a small number, and the shark fin. Those two, the charity ends up with the most out of all the rest of them.
Right. That's exactly right.
Whereas I think that many people would select that without running numbers, saying that they'll pay less to charity. But over the life of the term, we see here in both examples, the charity got more than they would have got.
Right. Now, I'm just going to click delete a bunch of times and start over here. So, and I'm going to click File New. So I'm going to go back to a CLAT. It's a grantor CLAT. Now, the inputs that we did not have before that we've added are these vertical lines. So the vertical lines items we didn't have in the simple CLAT. So it's a grantor CLAT, and it's marked.
Okay.
Again, we know to use February 8th. We could say the grantor's 60. So we have a life expectancy now of 23 years. Whenever I click this up or down, it's going to change the life expectancy. It's just something to tell us. We can put in the date of birth if we like. Then term of the CLAT, why don't we go to 20 years? Because I think you think 20 years is probably the industry standard, Paul?
I don't know if there is necessarily an industry standard. Like I said, mine tended to be longer, but I think I don't. I certainly don't know why I would argue against 20.
Yep. Okay. And then we can illustrate 30 years. And why would I want to illustrate more than 20? Well, because if I'm comparing this with another technique that might go 30 years, then I can go ahead and go to 30 years. So we'll start with level, and how much of a gift do we want? It doesn't matter. It's a very small gift. We're targeting a zero gift, which is completely appropriate for a CLAT, unlike a GRAT, where people recommend at least a small gift. Annual growth rate, 7.5%. Income tax rate, 37%. And ordinary income will be, we'll say, 2% of the value of all the investments. And we're starting with $1 million in there. So across the top, what we call the CLAT summaries, we have a lot of numbers. Just so you know, when you click alter summary columns, you can have even more numbers. Year of death, number of years illustrated, 75/20 rate, payout rate, annuity factor, reportable gift value. Now you could show all these things, and I'll open the screen up a little bit. So I've got a 60-year-old life expectancy, 23 years, dies in year 25. We're going to illustrate 30 years. It's a grantor trust. We're not taking a discount yet. And racing over here, 70% is going to go to charity, 30% is going to go to the remainder. And then we have a handy dandy spreadsheet. So when I click on these two horizontal lines, I can move that spreadsheet up so you can see the spreadsheet. And it is basically an Excel spreadsheet. I can click alter detail columns below and show some or all of these columns. And this is showing me the year of death in pink and the end of the term there. And it's also showing me the probability of survival to the 20th year, which is 6.4%. And by the way, I can click here and show every other year, or I can click there and show every third year. It's showing me my annual growth on what's inside the CLAT. It's showing me those equal annual CLAT amounts, the end value. It's showing me the ordinary income, and then it's showing me the income tax savings of $362,000 when I put the assets in. But then it's going to cost me about $7,000 of income tax a year. So my net positive here is $231,000 of income tax savings. And so the present value of that is $264,000 of income tax savings. Now, before I go on to CLAT number 2, I'll just mention that I can export the spreadsheet. Any spreadsheet you see here, I can export to Excel by clicking Export to Excel. And then all I have to do is click on the Excel spreadsheet, and it opens up, and it's an editable, not edible, but editable Excel spreadsheet. If they were chocolate, then they would be editable. So
now that would be edible. But I will tell you that working with Estate View, as I've seen it evolve, it's phenomenally easy, even for somebody like me. I have figured out how to get around in it because it's not counterintuitive at all, and it does a very, very solid job of you giving it what it's wanting and explaining what it wants well. So no, it's arranged wonderfully well. I would encourage anybody who hadn't been there to see it. You owe it to yourself to go see it, because it is as easy as I just described.
Yeah, the inputs really give you every option that we are aware of for the technique.
Mhm.
And then the outputs give you every output that we've wanted to see and that other people have wanted to see. Now, when you click on timelines and charts, this shows you the CLAT in terms of the original funding. The green is the growth of the income. The red is the annuity monies coming out. And you just see a tremendous amount of assets going to the children at the end of it. And this is what the CLAT uh, looks like as far as the values over time. But now, as we did before, CLAT number 2, I'll go to 120, I mean, to a 20% increase. So you immediately see a lot more savings. And now I'm going to also go to Pro Plus here. So I clicked on Pro Plus, and there's just a couple more features that are available now. And those features are the ability to discount the contribution to the CLAT by using an LLC or a limited partnership or something like that. So you see that CLAT number 2, the end value is 2,000,006. There's no discounts with CLAT number 2. I'll go ahead and do CLAT number 3 here. Go to the bottom and use a discount rate. And Paul, what kind of discount rate would you use for a 20-year CLAT? Because it's going to have to make payments every year for 20 years. I think the IRS is not going to want to allow the same robust discount as a situation where you're not going to have a lot of distributions made.
Well, I'll be honest with you, most of the ones that I set up, I don't think any of them paid more than maybe 3.5%, maybe 4, maybe one of them at 4, but a couple of them I know were at like 2.5. So, in other words, compare that to the private foundation 5% minimum payout on fair market value. I mean,
Yeah.
it's not anywhere close to that. But I think that going above, I think anything you go above the inflation rate is risky. Base inflation like 2%. Anything going above that, you may be securing the ultimate doom of the foundation not be able to keep up.
Yeah. But here's what I'll show you. If I take a 15% discount for lack of marketability and lack of control in a 20-year CLAT that's increasing by 20% a year, as you see there, just that little 15% discount brings me from 2,000,007 to my descendants to 3,000,005 for my descendants. And that brings me to an estimated net present value of about 50/50. So that's not bad. So that's with a 15% discount. But let's go ahead and look at it again for a 30% discount. Jerry tells me not to go above 30. It's hard to find an appraiser who's not in the high 30s, but assuming you could find an appraiser at 30.
A combined discount for lack of control and marketability of more than 30.
Yeah.
I think most will go above that.
Right. Well, that's going to get my descendants 4,000,004.
Yeah.
That's a pretty good day. Now my descendants are at 60%. Now, just so you can see, you can get more fancy here by putting in both discounted assets and non-discounted assets. So, you may want to put some cash in there to handle the first few years' payments, and then less in the LLC with a discount. So that's all available to you. And then you also may tell me, Alan, I don't think a 5% time value of money discount is appropriate. I think it should be 6%. Well, I could just click up to 6% and you can just see how all the numbers will change there. But what I want to do next is now I
No, wait. Let me ask you, what is the time value of money discount compared to the discount for lack of marketability?
okay, well, the discount for lack of marketability would go here and would you're basically telling the CLAT, I'm not giving you 1 million, I'm giving you 700,000.
Now, I know that. I know that. My point is, what is the distinction between your discount for lack of marketability, which is was your 30 discount, and your discount for the time value of money?
The discount for the time value of money is only to adjust what we think the present value of the remainder is. It doesn't adjust anything within the CLAT, but when I show the client, you know, it's great, your kids are going to get 4,000,004, but really 4,000,004 in 20 years, the present value of that is about 1,038,000 using a 5% discount rate. If I use a
Okay, so that is not iterative in the CLAT calculation. That's on the back end of the remainder computation.
right,
Got it.
right,
Got it. Okay. I wouldn't. I thought you were taking an additional valuation discount,
no,
and I was like, I know I've been in debates with appraisers on the difference between the liquidity discount and the discount for lack of marketability, and there are some very slight differences, but for the most part, the discount for liquidity is the same as the discount for lack of marketability.
right, right. Okay, so why don't we stay at a 25% discount? And now let's move to CLAT number 5. I'll click duplicate. And CLAT number 5, now we're going to go back to the payment. And let me find the payment line here. We're going to go from increasing 20% a year to shark fin. So I click on shark fin. There's your shark fin again. It doesn't make the jaws sound because I didn't want to violate copyright. And there's going to have to be some annuity, so we just decided 1% a year. So uh, the first annual payment, the annual payments you see for CLAT number 5 are very small, just 7,500 a year. And what's left for the descendants at the end is pretty impressive. Now it's at 4,638,000. So now you can tell the client that there's a good chance that 60% of this remainder is going to go to the children, 40% to charity, and that's on a net present value basis. So that's pretty much what I want to show the client.
Let me ask you two questions about the shark fin CLAT. First of all, has the IRS ever issued a private letter ruling pertaining to shark fin CLATs?
No,
Yeah, I wasn't aware of one, and I didn't know if you knew of one
nope.
or of any inkling about any, because I haven't heard a thing. And secondly, why would you, or what would lead you to believe that you can actually do that? But what I've seen is people think about that and they're going to make a private foundation the beneficiary, and then they're not totally following the rules, and all of a sudden you think about prohibited transactions and all these kind of things. So I'm not sold on the viability of the shark fin CLAT. It's a great concept. But until I see something on it, I'm leery about it. And as you see in your projections, you end up paying more, where a lot of times people try to sell them on the shark fin. I mean, I've had people approach me about it because you end up paying less, whereas your numbers don't say that. I mean, that belies the truth.
You have a good point. Paul Lee has, really promoted the shark fin. CLAT, some of the other big hitters are using them, but it is a little safer not to use it or to have the shark fin payment be a larger amount. You could make the shark fin payment $25,000 a year, and then it's a little bit better than the.
That's hedging your bet.
That's hedging your bet. That's right. Okay, so now I've decided that I like CLATs 4 and 5 best. So I'd like to share that with the client. So I click on General Explanation, and I'm going to click on CLAT 4, CLAT 5, and PowerPoint presentation. Put in a client's name, click Submit. And then there on my Google Chrome, underneath the arrow down, I have a PowerPoint for CLAT 4 and a PowerPoint for CLAT 5. So we'll
And
go.
y'all, this is where Estate View really takes the cake, is in creation of not only the explanations, but of the PowerPoints.
So the PowerPoint created for my friend Paul Hood describes a grantor lifetime CLAT, describes a non-grantor T-CLAT, and then gives you the numbers. So I can tell the client, here's the numbers I used. The grantor put $1 million into the LLC, so transferred a 99% non-voting member interest to the CLAT, used a 25% discount, and the charity will receive the 8137 the first year, and the remainder value 4,181,000, not GST exempt. And here's the summary of the spreadsheet with a nice in value. So, and then more information about what you could put in a CLAT, what you shouldn't put in a CLAT, how it might work. So that's the first PowerPoint. And then the second PowerPoint, oops, I just accidentally turned off the Estate View. Let me get it back on here. The second PowerPoint is the same. It's just showing you the second illustration. The next thing I can do is I can share this with my colleagues, my clients. So I click on Share with Client, create URL, copy to clipboard, and now I can start an email. Dear Paul, go to the following HTTP address, click on it, put in 166706 as your code, and then you have 2 weeks to use this module with the settings already intact there. So that way the CPA, the financial planner, the tax lawyer, and the intelligent client can all play around with this module and decide what they want to do. The next thing I'll do is I'll go to File, Save As, put in Paul Hood, March CLAT, hit Save. Now it is saved to my computer. Now, Estate View is a web-based, cloud-based. It's an Amazon cloud based upon Microsoft C# program. So Estate View doesn't access your numbers. Our website doesn't know what you're doing with it, but your computer reaches into our cloud site to use the software. You can use it on an iPad or any tablet, or even on your phone, and of course on your computer, whether Apple or not Apple. So I'm going to want to save it. Now, I can also save my screenshots. I can just click on the camera there, and now I can go there and I have a picture that I took of what I'm doing, so that at least you have that for your convenience. Shows up like that. So now if I get booted out of Estate View, or I accidentally click out of Estate View, I'm sorry, you got my emails there. Let me get back onto Estate View. We'll be editing this a little bit. Okay, so I got out of Estate View. Now I go back to my cursor. I go to estateview.link, and I'll go to CLAT, and it has saved my settings. So they're all still there. They're all there until I click File New. When I click File New, I start from scratch. So Paul, anything else you want to cover under this module before we
No,
go?
I think this demonstrates not only the calculation capabilities and flexibility, but where Estate View really sets itself apart, in my opinion, and that's in the explanatory. And you didn't show the actual ability to delegate within, if you work with other people, responsibilities along the way. It's a way to do that too and communicate with them at the same time, which I think is phenomenal.
Thank you. I'll also mention that, and this does relate to CLATs, if you want to buy life insurance on the client, and that's part of influencing the situation, the client's age 60, you go to the life insurance estimate part of Estate View, and it will tell you for a 60-year-old to buy, let's say, $2.5 million of life insurance, a 20-year level term would typically cost between $9,200 and $13,000 a year. So that might be something that would be budgeted if the client is concerned that the recapture of the income tax deduction would be problematic. And of course, that could be put into an irrevocable life insurance trust. So now another thing I'll just mention to run the numbers is the same client, you may want to say to the same client, let's look at your IRA minimum distributions. And with your IRA minimum distributions, let's think about how much income tax you would save if you just have that equivalent amount go to a charity every year from your required minimum distributions. So that's just another use of Estate View for that.
The QCD out of the IRA.
Mm-hmm.
Okay, yeah, that's a great idea. It's a underutilized tool.
Yeah, and we allow the QCD to come either only from the RMD or at 70 and a half, regardless of the RMD.
Right.
So you have that ability. So let's go back to the slideshow here. And by the way, if you have any questions or any comments or any issues, please let us know. You've got our email addresses there at the bottom. We prefer that you send me the easy questions and Paul the hard questions. Then you'll get some answers.
I'm just gonna send the hard ones rhetorically back to you. Repackage them, regift those hard questions.
Right, right. So, something else I wanted to mention, Paul, is a lot of clients do want to zero out their estate tax using charitable. And certainly the charitable lead annuity trust is a way to do that. But another way to do that is the administrative note purchase. And do you want to review the administrative note purchase, or do you want me to?
Go ahead, take us through it. Take us through your diagram here.
Yeah. Well, to oversimplify this, the client wants to leave assets to a charitable lead annuity trust, but maybe there's assets that the children want to receive. and they don't want to disclaim those assets into the CLAT and have to wait 20 years or 25 years to get access to them. So if things are set up properly, those assets can go directly to a family private operating foundation, and the children can buy the discounted LLC interest from the family operating foundation for what they call an administrative note. It's an exception to the self-dealing rules. You have to have certain paperwork in place before the client dies. But the children could end up buying the assets from the private operating foundation on a 20-year note at the applicable federal rate, which is better than they're going to get from the bank. And then later on, so now there's no estate tax, but they're going to pay interest to the private operating foundation. That's going to be tax deductible to them. It's not going to be taxable income to the private operating foundation. And then if they can convert the private operating foundation to a public charity, or it starts off as a public charity, then they may be able to buy that note right out. They may be able to get it to discount the note. So it may be $100 million note, interest only, 20 years at about 4.85% interest. But they could go to the organization and say, would you rather wait 20 years for $100 million, or would you rather have $70 million right now? And our note has been appraised at $70 million. So then that public foundation accepts the 70 million, and that would be an alternative to a charitable annuity.
Hasn't the IRS stopped issuing private letter rulings on this transaction? I think this is one of the ones they have.
I think they've stopped issuing rulings where the note is wrapped in an LLC.
Yeah, well, I knew that, but I thought they kind of hedged it out to cover this far as well. But maybe I'm wrong.
Yeah, I don't think so. I'll double check, but I don't think so. The other thing I wanted to point out is, if you have a client that wants to leave everything to charity, don't. At least leave the exemption amount to a non-grantor trust that doesn't have to qualify as a 501c3. And by the way, how do you turn a private foundation into a public charity? Well, make it into a school. Use some of its resources to have a physical school building, a faculty, and a curriculum. And the IRS has even ruled that a karate school that just teaches karate would qualify for that. Now, our slides go on and on, like everyone else's slides, on the characteristics of the various charitable entities, including charitable lead annuity trusts. The unrelated business taxable income rules will be a problem for a non-grantor CLAT, but not a grantor CLAT. You can have S corporation stock owned by a grantor CLAT. You can have S corporation stock owned by a electing small business trust, which you can make a non-grantor CLAT, an electing small business trust. You have to be very careful when you have a business organization involved with a CLAT or any of these types of entities. Don't do this at home. Get help from somebody who
Definitely not.
Get help from somebody who understands the trips and traps.
Are you going to be heading to the national office seeking an inadvertent termination ruling?
Yeah, those are not fun. Those are not fun. You have to understand the self-dealing and the excess business holding rules. There's my illustration of somebody leaving the amount that passes estate tax-free to a trust that may be 100% for charity, but would not be a 501c3 organization bound by all these charitable rules.
I think it's one of the most useful, having a non-qualified. Well, look what Mark Zuckerberg and Priscilla Chan did with the charitable LLC. And they just said, to heck with, we like subchapter K better than we like the tax exempt rule.
Yeah. That's a very That's a very good point. Let me see what else I had here. So I will be updating these charts to show today how these numbers come out now. But this is a good way to illustrate to the client by spreadsheet, separate and apart from estate view, how 12-year equal payments, 12-year increasing payments, 20-year equal, 20-year increasing with a 33% discount, and the percentages that end up going to the various interest groups. So this can be very instructive. Beginning on page 51, I have laid out the differences between the grantor CLAT and the non-grantor CLAT. Paul, have you ever seen a CLAT that was not zeroed out?
I saw one. I didn't draft it. I never drafted one that wasn't, well, on the testamentary side. Now on the grantor CLAT side, they were all, small percentage, fixed term kind of things. But no, to answer your question on the testamentary side is no, they're all formula zeroed out.
Right. Paul, have you used a CLAT or have you seen the use of a CLAT as an overflow provision in an irrevocable trust that
I
says,
I have not. I don't know why you wouldn't consider it. Some people think, well, make a Q-tip or Q-tippable trust or a GRAT. To me, you probably get more flexibility in the end if you consider this third option. The grantor CLAT, the conversion. I think that may be, as an overflow, that may be for many people a very viable and even a preferable option.
have you seen the CLAT that says that this CLAT will pay charity for 20 years, and then what's left in it after 20 years will come back to me? So I'll get a tax deduction for what I'm putting in 100%, but a real probability that I'll get more money back in 20 years and then be able to give it again and get another income tax deduction.
I have never seen that. Now, obviously someone else will be the trustee, because I would argue that if the client could do that and be the trustee, they never created a trust to begin with, because the client has legal and equitable title and hasn't transferred anything.
There would be that argument. I've never seen one done. I've read about
I haven't either, and I wouldn't want to be the first. Pioneers often end up with arrows in their back, remember?
Exactly. So should we talk about the Keenan gain? Just to remind everyone about the Keenan gain.
It's always, worth remembering, if you're going to distribute anything from a trust in exchange for any value using an asset other than cash, you best be aware of the asset that you're about to transfer's adjusted income tax basis, because the difference between the fair market value of that asset and its basis is going to be Keenan gain.
So if I set up a grantor CLAT, I'm considered to be the owner of the CLAT for income tax purposes. I put appreciated stock in there, and then the CLAT pays the stock to charity to satisfy a $100,000 a year charitable obligation. I think the IRS believes that that triggers capital gains to me. Although it doesn't seem that way, because it doesn't seem that I'm satisfying the obligation. So I don't know if they're going to be successful in taking that position, but I think they do.
Well, I mean, the grantor trust rules are hardly a model of clarity. Okay. Um, but if you think about it, you have an obligation to charity. Now, is it a legal obligation? Okay, because it's stuff is being transferred from your grantor income tax trust of your property that was yours before in exchange for dollar value for whatever it is you owe. It's $100,000 a year pledge or whatever it is. If you did it directly, you'd have gain, right? If you tried to pony up now, well, no, I take that back. Well, no, wait. If it's in exchange for something, that's different. Now, because people can make gifts of highly appreciated marketable securities directly to charity and avoid the capital gain. But that's just a donative unilateral gift. If it's in exchange for something like a pledge, even a legally enforceable pledge, I think I wouldn't want to argue against the existence of Keenan gain in that example. I think you have the worst side of the case.
Yeah. Yeah. So that has to be taken into account.
Exactly.
Now, if it's a non-grantor trust, then the trust carries out, gets a deduction for what it pays to the charity.
Well, no, if the charity, if the trust owes something to the charity and pays it with assets other than cash, the trust could have or will have what is in essence Keenan gain.
But that'll be offset by the transfer to the charity.
Yeah, obviously, and if it's a 642C, you don't have to worry about the contribution based percentage limitations of 170. You're in the 640s. You're in much better shape. You're not limited to the 50% AGI, with cash to public charities. You may net perfectly. It just depends on your tax rate.
Right. Okay. And then there is the ESBIT election private letter ruling 2007-47001.
I wrote an article about that. I remember that one.
Nice. So then our time's up, but we do have materials from Jerry Hash. We appreciate everything that Jerry's done. You've got examples and information. Jerry believes that it's best not to do the shark fin, just do the 20% a year increase, because that's good enough, if there's any such thing as good enough. Finally, I just want to mention that you do end up seeing situations where a lifetime CLAT, the grantor gets older and older and wants to give more and more away. And the children become more and more important in decision making, and they don't want to give as much away. So the IRS does allow you to accelerate the payments to charity, but not at a discount. So I recently, for example, had a CLAT that was going to pay another $300,000 a year for 5 years to a synagogue. And grandpa said, "Oh, I'll give $1 million to the synagogue." So the children said, "No, you won't. We'll just accelerate the next payments to get to $1 million." So just kind of keep that in mind. There's no discounted way out of a CLAT, but there is in general the ability to accelerate payments without a discount. Paul, any final questions, comments, or suggestions?
No, the CLAT was a garden variety tool, and I believe it remains one of the finest bases for an estate plan.
Thank you very much. And thanks for your suggestions on diving into Estate View. It's just a matter of kind of picking through it one button at a time. Every
It
button
is,
has its purpose.
but it's easy to do. That's the point.
Yeah, yeah. All right. Well, thanks so much to everyone who attended, and thanks for Lineberg Information Services. Great, great people trying to provide the best of content. Please email us with any questions, comments, or suggestions, and may the rest of your day be as fantastic as I hope the first part was.